So today we'll talk about the topic liquid assets. Liquid assets and how can one consider to invest their saving of profits. Welcome to my channel, where we bring you the latest insights and perspectives on investing and financial knowledge from around the world. Liquid assets are investments that can be easily bought and sold without significant price fluctuations and can be converted into cash relatively quickly. Some examples of liquid assets include 1. Cash and cash equivalents, such as savings accounts, checking accounts, and money market accounts. 2. Stocks, which are shares of ownership in a company that are traded on public stock exchanges. Many stocks are highly liquid and can be bought and sold quickly. 3. Bonds, which are debt securities issued by companies, municipalities, or governments. Many bonds are traded on public markets and can be bought and sold relatively easily. 4. Exchange-traded funds, ETFs, which are investment funds that trade on stock exchanges like individual stocks. ETFs are typically highly liquid and can provide exposure to a wide range of asset classes, including stocks, bonds, and commodities. 5. Commodities, such as gold, silver, and oil. While some commodities are highly liquid, others may be less so. 6. Cryptocurrencies, such as Bitcoin and Ethereum, highly volatile and may not be suitable for all investors, but they can offer high liquidity and the potential for significant returns. It's important to keep in mind that all investments involve risk, and there is no guarantee of returns. When investing in liquid assets, it's important to do your own research, diversify your portfolio, and consult with a financial advisor or other qualified professional before making any investment decisions. Here are some highlights of investment I like to invest in. 1. Real estate. Real estate is a popular investment option that has the potential to provide both rental income and appreciation in value over time. One way to invest in real estate is to buy a rental property and earn rental income from tenants. Another way is to invest in real estate investment trusts, REITs, which are companies that own and manage income-producing properties. REITs can be bought and sold like stocks, and many offer high dividends to investors. Real estate can be less liquid than other investments, but can still be sold relatively quickly in most cases. 2. Gold. Gold is a popular investment option that has been used as a store of value for centuries. It can be bought in the form of physical bullion or coins, or through exchange-traded funds, ETFs, that hold physical gold. Gold can provide a hedge against inflation and economic uncertainty, but its value can be volatile over short periods. Gold is considered a relatively liquid asset that can be sold quickly in most markets. 3. Commodities. Commodities are physical goods that are used in the production of other goods or services. Examples of commodities include oil, natural gas, wheat, corn, and livestock. Investors can buy and sell commodities through futures contracts, options contracts, or ETFs that hold physical commodities. Commodities can provide a hedge against inflation and can offer diversification benefits to a portfolio. However, commodity prices can be volatile, and investing in commodities can be risky. 4. Cryptocurrencies. Cryptocurrencies are digital assets that use encryption techniques to secure transactions and control the creation of new units. Bitcoin and Ethereum are two examples of popular cryptocurrencies. Cryptocurrencies can provide high potential returns, but they are also highly volatile and can be subject to fraud, theft, and regulatory risks. Cryptocurrencies can be bought and sold on cryptocurrency exchanges and can be stored in digital wallets. When investing in these assets, it's important to consider your investment goals, risk tolerance, and investment horizon. All investments involve risk, and it's important to do your research and consult with a financial advisor or other qualified professional before making any investment decisions. To justify the investments, here are some examples with sources that can provide some insight into the ROI and the mode of investments. 1. Real estate. Real estate is an investment in physical property that has the potential to generate both rental income and appreciation in value over time. The two primary ways to invest in real estate are through direct ownership of rental properties or real estate investment trusts. According to the National Council of Real Estate Investment Fiduciaries, the annualized return of private real estate investment in the U.S. over the last 2 decades, 2001 to 2020, was approximately 5.7%. Mode of investment. Direct ownership of rental properties requires significant upfront capital, ongoing management, and maintenance expenses. Alternatively, investing in REITs offers a more passive approach to investing in real estate, allowing investors to invest in professionally managed portfolios of income-producing properties. REITs can be purchased through a brokerage account, and many offer high dividend yields. 2. Gold. Gold is a precious metal that has been used as a store of value for centuries. Investors can purchase physical gold bullion or coins or invest in exchange-traded funds, ETFs, that hold physical gold. The annualized return of gold over the last 2 decades, 2001 to 2020, was approximately 9.6%, according to data from the World Gold Council. Mode of investment. Physical gold can be purchased through reputable dealers or online retailers. Alternatively, investing in gold ETFs offers a more liquid and accessible approach to investing in gold, as ETF shares can be bought and sold through a brokerage account. 3. Commodities. Commodities are physical goods that are used in the production of other goods or services. Examples of commodities include oil, natural gas, wheat, corn, and livestock. Investors can buy and sell commodities through futures contracts, options contracts, or ETFs that hold physical commodities. According to the S&P GSCI Total Return Index, the annualized return of commodities over the last 2 decades, 2001 to 2020, was approximately 3.6%. Mode of investment. Investing in commodities through futures contracts or options contracts requires a high level of expertise and risk management. Alternatively, investing in commodity ETFs provides a more accessible and liquid approach to investing in commodities. 4. Cryptocurrencies. Cryptocurrencies are digital assets that use encryption techniques to secure transactions and control the creation of new units. Bitcoin and Ethereum are 2 examples of popular cryptocurrencies. Cryptocurrencies can be bought and sold on cryptocurrency exchanges and stored in digital wallets. According to CoinDesk, the annualized return of Bitcoin from its inception in 2009 to the end of 2020 was approximately 198.4%, with significant variations in return over different periods. The annualized return of Ethereum over the last 5 years was approximately 107.5%. Mode of investment. Investing in cryptocurrencies requires a significant level of technical knowledge and understanding of the underlying technology. Cryptocurrencies can be purchased through cryptocurrency exchanges or online brokers that offer access to digital assets. It's important to note that cryptocurrencies are highly volatile and subject to significant regulatory and security risks. The approximate annualized returns for each investment over the last 2 decades, as of 2021. This investment can be the best alternative to hedge against the current inflation. Here are some more details. 1. Real estate. Real estate is often considered a good hedge against inflation because property values and rental income tend to rise with inflation. For example, if there is a general increase in the price level of goods and services in an economy, this may also lead to an increase in the cost of building materials, labor, and other expenses related to owning and managing property. As a result, the value of real estate assets can increase over time, and rents can rise as well, providing a natural hedge against inflation. To justify, during the 2008 financial crisis, while the stock market was plummeting, real estate prices remained relatively stable, and rental rates continued to increase. This means that real estate investors were able to maintain their purchasing power and income streams during a period of high inflation. In 2011, the U.S. experienced a higher than average rate of inflation due to rising commodity prices, including oil and gas. During that time, rental properties were able to command higher rents due to the increased cost of living, providing a hedge against inflation for real estate investors. 2. Gold. Gold is often considered a hedge against inflation because its value tends to rise when the purchasing power of paper currencies declines. For example, in the 1970s, when inflation was high, the price of gold increased by over 300% due to high inflation rates in the United States. During this period, the value of the U.S. dollar declined due to the expansion of the money supply, and investors sought refuge in gold as a store of value. The gold prices increased significantly, rising from around $35 per ounce in 1970 to over $800 per ounce in 1980. In 1974, the annual inflation rate was around 11%, while the annual return on gold was around 73%. Since gold is a tangible asset that is not directly tied to the performance of any particular economy or currency, it can provide a hedge against inflation over the long term. 3. Commodities. Commodities are often used as a hedge against inflation because their prices tend to rise during periods of high inflation. For example, if there is a general increase in the price level of goods and services in an economy, this may also lead to an increase in the prices of raw materials, such as oil, natural gas, and metals, which are used in the production of other goods and services. As a result, the prices of commodities can rise along with inflation, providing a natural hedge against it. During the inflationary period of the 1970s, commodity prices increased significantly, with the Dow Jones UBS Commodity Index rising from around 50 in 1970 to over 300 in 1980. In 1977, the annual inflation rate was around 6.5%, while the annual return on commodities was around 20%. In 2010, the price of oil and other commodities rose significantly due to concerns about supply disruptions and geopolitical tensions in oil-producing countries. This increase in commodity prices acted as a hedge against inflation for investors in commodity-based assets. For cryptocurrencies, cryptocurrencies are sometimes viewed as a hedge against inflation because they are not tied to any particular currency or economy, and their supply is limited. For example, Bitcoin has a maximum supply of 21 million units, which is expected to be reached around the year 2140. This limited supply means that Bitcoin is not subject to inflationary pressures from central bank money printing or government fiscal policies. However, it is important to note that cryptocurrencies are still a relatively new and volatile asset class, and their use as a hedge against inflation is still being studied and debated. For example, during the inflationary period of 2020-2021, Bitcoin prices increased significantly, rising from around $5,000 per coin in March 2020 to over $60,000 per coin in April 2021. In 2020, the annual inflation rate in the US was around 1.4%, while the annual return on Bitcoin was around 300%. However, it's important to note that cryptocurrencies can be highly volatile and are subject to regulatory risks, so they may not be suitable for all investors seeking to hedge against inflation. Future perspective for these class of assets. Predicting the future performance of investments is difficult and uncertain, as many factors can impact their performance. However, some experts believe that real estate, gold, commodities, and cryptocurrencies could continue to be significant investments in the future for various reasons. 1. Real estate. Real estate will likely continue to be a significant investment in the future as populations grow and urbanization increases. Additionally, the COVID-19 pandemic has led to a shift in preferences toward larger living spaces, which could increase demand for single-family homes in suburban areas. However, rising interest rates could make it more expensive to finance real estate purchases and could impact the affordability of mortgages. Additionally, climate change and natural disasters could impact the value of coastal properties and those in areas prone to flooding. 2. Gold. Gold is likely to remain a significant investment in the future as it is viewed as a safe haven asset during times of economic uncertainty and geopolitical risk. However, changes in the global economy, such as the shift towards a digital economy, could impact demand for physical gold. Additionally, technological advances could make it easier to mine and produce gold, which could impact its value. 3. Commodities. Commodities will likely continue to be important investments in the future as they are essential to the production of goods and services. Additionally, as the global population grows, demand for commodities such as food and energy will likely increase. However, advances in technology, such as renewable energy sources, could impact demand for traditional commodities such as oil and natural gas. 4. Cryptocurrencies. The future significance of cryptocurrencies is less certain, as the regulatory environment and technological developments could impact their value and utility. However, the growing acceptance and adoption of cryptocurrencies by institutional investors and businesses could increase their importance as an investment option. Additionally, the increasing use of blockchain technology in various industries could lead to further development and adoption of cryptocurrencies. However, cryptocurrencies remain a highly speculative and volatile investment, and investors should exercise caution and perform thorough research before investing. Keep watching the videos to keep yourself updated on the current circumstances.